So, today we're going to unpack a really interesting document called Navigating the New Disorder. It gives us 6 key lessons for anyone trying to figure out a market that, let's be honest, seems to be pulling in completely opposite directions at the same time. Let's dive right in. And this right here is the big question, isn't it? It's the central dilemma every investor is facing. The signals are all over the place. So what do? Do you try to make a profit right now, or do you start building walls for a storm that might be coming down the road? This really frames that conflict perfectly. On one hand, you've got these tactical, short-term opportunities that seem ripe for the picking. But on the other hand, you have these deep, long-term structural risks that you just can't afford to ignore. We're going to explore both sides of this coin, and we'll start with the opportunities. All right, so let's kick things off with part 1, 3 tactical opportunities. This is the whole profit now side of the argument. The idea that, yeah, things are uncertain, but there are still some really smart plays to be made in the market today. So our first lesson has a great name, the taco trade. And it all boils down to one simple strategy: buy the dip. And no, we're not talking about lunch here. It's actually an acronym that describes a very specific dynamic between politics and the market. TACO actually stands for Trump Always Chickens Out. Now, here's the theory. A politician announces some controversial new policy. The market freaks out and sells off. But then that sell-off creates so much political pushback that the policy gets walked back or softened, so the dip doesn't last. The actionable advice here? Be disciplined. Instead of panic selling, you systematically buy into these dips that are driven by policy noise. Okay, lesson number 2. This one is all about the surprising toughness of our financial system. After the 2008 crisis, everyone was waiting for the next big shock to bring the whole thing crashing down. But, well, that just hasn't happened. I mean, just think about what the system has absorbed in just the last few years. A global pandemic that shut everything down, a massive war in Europe, major trade tariffs. The source material says it perfectly. The plumbing has held. So what's that mean for you? It suggests that you shouldn't just dump all your stocks based on fear of some macro event. The system has proven to be way more robust than a lot of people gave it credit for. All right, our third tactical lesson is all about the staying power of the US dollar and US assets. You hear all this talk about de-dollarization, but when things get chaotic on the world stage, where does all the money flow? It consistently goes to the same place. And just look at this number. We're talking about a US debt of nearly $39 trillion. It's staggering. And yet, whenever there's a risk-off event, when global investors get scared, they still flood into US markets like they're the safest harbor in the world. So the takeaway here is, for the short to medium term at least, having a big chunk of your portfolio in US assets is still a really solid anchor. Okay, we've looked at the opportunities. We've talked about the reasons to be optimistic in the short term. But now we have to flip the coin and look at the other side. Welcome to part 2. 3 major structural risks, the kind of long-term problems that this paper argues investors are dangerously ignoring. Our fourth lesson is summed up in this fantastic phrase: molecules matter. It's a really sharp reminder that for all our excitement about the digital world and tech stocks, the global economy still runs on actual physical stuff, and the market might be forgetting that. We're talking about the sectors that produce physical things: energy, chemicals, raw materials. For a while now, they've kind of been pushed aside in favor of high-growth tech, or even sidelined because of ESG trends. But with supply chains getting shakier, the argument is that adding some exposure to these molecule sectors could actually be a really critical hedge. And that idea about supply chains leads us straight into lesson number 5. This one focuses on critical weak spots, or choke points, in our global system. Places that could cause massive, massive disruptions if something goes wrong. And you can see some really clear examples here. Key shipping lanes like the Strait of Hormuz, the supply of rare earth minerals for our electronics, even the basic ingredients for our pharmaceuticals. A lot of this stuff is concentrated in just a few places, many of them outside of Western control. The market doesn't really reward companies for having backup plans, which means this risk is almost systematically ignored. And that brings us to our 6th and final lesson, and honestly, this one's the most sobering. The argument is that the very success of our short-term strategies, like that taco trade we talked about, it creates a really dangerous sense of complacency. We've just gotten so used to things bouncing back that we're failing to price in the possibility of a real honest-to-goodness catastrophe. And this quote from investor Ray Dalio is, well, it's chilling. Comparing today to the late 1930s is a serious, serious warning. It's a stark reminder that things that seem totally unimaginable today can absolutely become reality tomorrow. And maybe, just maybe, investors should be setting aside a part of their budget to insure against these worst-case scenarios. So what do we do with all this? We've got these short-term opportunities pulling us one way, and these huge long-term risks pulling us in the other. How in the world do you balance that? Well, that brings us to our synthesis, the Investor's Balancing Act. This table lays it all out pretty clearly. Your tactical moves are things like buying those policy-driven dips, not getting scared out of stocks, and keeping a solid U.S. allocation. But then you have your structural protections, adding commodities, looking for companies with strong supply chains, and maybe even buying some of that tail risk insurance. The core message is you kind of have to do both. You trade the short-term bounce, but you build long-term protection. And that leaves us with one final crucial question for you to think about. When you look at your own strategy, is it built for the next bounce, or is it built for a potential break? In the market we're in today, the answer probably needs to be both.